So is it really your own money if you actually have to pay interest to get your hands on it? That's the really interesting question, maybe even a bit frustrating, that we're diving into today. We're talking about life insurance policy loans. Now, this isn't some, obscure financial thing. It's a feature built right into permanent life insurance that lets you access something called cash value. But, well, as we'll definitely see, it's got some surprising flexibility, but also hidden costs and potential traps that are not obvious when you first hear about it. Our goal today, using the stuff a listener sent us, articles from experts, Investopedia, and a really telling example from an online forum, is to cut through the noise, get to the practical reality, and help you figure out if using that cash value in your whole life or universal life policy makes sense for your financial life.
Exactly. You hear borrow from your life insurance, and it sounds, simple. Maybe a little too good to be true, right?
Yeah.
And the sources we looked at make it pretty clear, while it can be flexible and powerful even, it's not like just, pulling cash out of your savings account. It's different. So we're going to use these materials to really dig into how that cash value even builds up in the first place, how the loan actually works, because, and this is key, it's a loan against the cash value, not a withdrawal of it.
Right.
Why you have to pay that interest, and critically, what happens if these loans aren't managed properly, because that's where things can go sideways.
Okay, let's break it down properly. Before we even get to the loan part, we really need to understand the kind of insurance policy where this is even a thing. I mean, most people get the basic idea of life insurance, right? You pay premiums, somebody passes away, beneficiaries get a death benefit, basic protection.
Right. And the most common type, the one people maybe know from work or something, is term life insurance. Just think of it as pure protection, straightforward. For a set amount of time, could be 10 years, 20, 30 years. You pay your premium. If you pass away during that term, the death benefit gets paid. Simple. And usually for the same amount of coverage, the starting premium for term life, it's going to be the lowest compared to other types.
But the key thing with term, it's right there in the name, it's temporary. If you're lucky enough to outlive the term, well, the policy just ends, expires. There's nothing else, no money back, no value returned. And this is important as you get older, or maybe your health changes, trying to get new term coverage or even renew an old policy. It gets way more expensive, sometimes just unaffordably expensive. The sources point out that actually a lot of term policies just lapse. Either people outlive them or the cost gets too high. So years of payments might not result in any direct financial return other than having had that protection during the term. And here's the connection for today. Term policies, they don't have cash value, none. So you absolutely cannot borrow from them.
Which brings us right to permanent life insurance. This is the category designed to cover you for your whole life, assuming you keep paying the premiums. We're talking things like whole life, universal life, indexed universal life. With whole life specifically, the deal is usually that the premiums and the death benefit are guaranteed, locked in for life. Doesn't matter if your health changes later, that guarantee holds. That's a huge difference from term. Now, the trade-off is the initial premiums are definitely higher than term for the same death benefit when you're young, but you're paying for that lifelong coverage. And crucially for us today, you're paying for the buildup of cash value.
Ah, yes, the cash value. That's the engine, right?
Yeah.
The thing that makes the policy loan possible. So part of every premium payment you make doesn't just cover the insurance cost. It goes into this separate bucket inside the policy, the cash value.
Exactly. It's like building up a reserve within the policy itself. And the insurance company, they take these funds and they invest them. For traditional whole life, the investments are typically pretty conservative, think bonds, things like that, aimed at stable, predictable growth. So the cash value grows over time. With whole life, there's usually a guaranteed minimum growth rate. It won't go down because the market tanks. And on top of that guarantee, if it's a participating policy, it might also pay out dividends, non-guaranteed, mind you, which can boost the cash value even more, or maybe use them to buy more coverage or lower your premiums. The sources mention those options. Universal life, indexed universal life. They have different ways cash value grows, maybe tied to interest rates or market indexes, but the basic idea is the same. Cash value accumulates.
And here's a really big perk. That growth inside the policy's cash value, it's usually tax deferred, meaning the earnings pile up year after year, and you don't owe income tax on them right away. That can be a huge advantage over decades compared to, say, money growing in a regular taxable brokerage account where you might get hit with taxes on dividends or gains every year.
Oh, yeah. It's a powerful compounding effect over the long term. And as that cash value builds, it actually helps the insurance company, too. It kind of offsets their risk as you get older, and the chance of paying the death benefit goes up. Basically, that growing cash value helps cover the rising internal cost of insuring you over time. But, we need to manage expectations here. Cash value doesn't just appear magically overnight. The sources generally say it takes maybe 2 to 5 years before you even start seeing a noticeable amount build up. And realistically, probably 10 years or more before you have a significant chunk you could actually borrow against for something substantial. It's definitely a long game.
Okay, so we've got the foundation. Permanent life insurance, lasts your whole life, higher initial premiums, those guarantees, and this key cash value part that grows tax deferred. Now we get to the loan itself. This is how you actually tap into that built up value while you're still alive without just cashing out the policy.
Right. So a policy loan is essentially borrowing money from the insurance company, and you're using the cash value that's accumulated in your policy as the only collateral for that loan. This is a really, really important point the sources stress. You are not just withdrawing your cash value. It's not like taking money out of a savings account. You're borrowing from the insurance company's general funds, and they're holding your policy's cash value as security. That ensures they get repaid either by you making payments or eventually from the death benefit itself.
And getting the loan, well, based on the sources, it sounds remarkably easy compared to, say, getting a bank loan. Once you've got enough cash value built up, and remember that takes time, you can usually borrow up to a certain percentage of it, maybe 90%, sometimes more, of the cash surrender value. And actually do it. Usually just check how much is available, maybe online or a quick call, decide how much you need. The sources often say maybe borrow less than you think you need initially. You can always go back for more at Sick and Wait. And then you just request the loan. Simple call, maybe an online form.
And this is where it really contrasts sharply with traditional loans. This is the unique part. There is no credit check. None. Your credit score. Totally irrelevant. They don't ask for income verification. You're not filling out some massive intrusive application about your job or your debts. It's a contractual right. It's part of the policy you bought. The sources hammer this point home that ease of access is a major plus. It also doesn't show up on your credit report. So taking a policy loan won't ding your credit score if you're looking to borrow elsewhere. And the money, it can show up pretty fast, often wired to you within, say, a week or so.
And the flexibility doesn't stop there. How you use the money, totally up to you. Unlike a mortgage that has to buy a house or a car loan for a car, policy loan funds can be used for literally anything. Emergencies, starting a business, college costs, buying a boat, supplementing a retirement. The insurance company doesn't care. No restrictions. That freedom is a big selling point you often hear from people who like these kinds of policies.
Which, kind of brings us back full circle to that tricky question we started with, that paradox that trips people up. If this cash value came from my premiums and it's kind of my money sitting in my policy, why the heck do I pay interest to borrow against it? It feels wrong somehow, counterintuitive.
It totally does. But the source material is very clear here. It kind of bursts that borrowing my own money bubble. You pay interest because you are borrowing from the insurance company's general pool of money, not literally scooping out of your own little cash value pot. The insurance company's giving you their capital, and that capital has a cost to them. They could be investing it elsewhere.
Precisely.
Yeah.
That money they lend you, they could have invested it and earned a return. So the interest they charge you is basically compensating them for that lost opportunity. It lets them keep earning something on their assets, even when they're loaned out to you. And that interest income helps keep the insurance company financially strong and profitable. And the sources argue that's actually good for you as the policyholder in the long run, because a financially stable insurer is more likely to be around to pay that death benefit decades down the road and meet all those guarantees in your policy.
So maybe think of it less like paying interest to yourself and more like paying the insurance company a fee for giving you that super flexible, easy access to cash using your policy value as the guarantee. You're paying for the use of their money, backed by your asset.
Yeah, and understanding how the interest actually works is key too. It's charged on whatever loan balance you have outstanding, just like any other loan. Now, the rates can be fixed, same rate for the life of the loan, or they can be variable. Variable rates, well, they often move based on some external benchmark. One source specifically mentioned the NAIC model law, which a lot of states follow. It often ties the rate to something like the Moody's corporate bond yield average, plus a little bit extra, a margin. These variable rates get reviewed periodically, maybe once a year, sometimes quarterly, but they usually only change if the benchmark moves significantly, like maybe 0.5% or more.
There was one detail in the source about interest being charged up front using a daily factor. That sounded a bit weird.
Yeah, that can look a bit confusing initially, but the sources sort of clarify that over the long run, if you're making payments, The math basically works out to whatever the stated rate is, fixed or variable. It's not like you're getting some kind of hidden discount. The real bottom line is interest accrues on the outstanding balance every day, usually. And here's the critical point, the one that leads to trouble. If you don't pay that interest as it accrues, the insurance company just adds it to your loan balance. Your debt grows. So your loan principal gets bigger and bigger over time, even if you never borrow another time.
And that compounding interest on an unpaid loan, that brings us squarely to the big downsides, which are kind of the flip side of that amazing repayment flexibility. Because flexibility is a huge plus, right? Typically, there's NO required payment schedule, no mandatory monthly payment, no deadline for paying back the principal, no late fees if you miss a payment in the short term. You have incredible control.
You really do. You can pay nothing for a while. You could just pay the interest each year to keep the balance level. You could throw chunks of principal at it whenever you have extra cash, or pay it all off in one go. Payments are usually easy check, electronic transfer, whatever. That level of flexibility, you just don't see that with most loans.
And it's a big but that needs flashing lights around it. While there's no required schedule, that loan and all the interest piling up, it doesn't just vanish if you don't pay it back while you're alive. The total outstanding loan balance principal plus all that accumulated unpaid interest gets deducted from the death benefit when you pass away.
Yeah, and that can seriously slash the amount your beneficiaries receive. It could completely undermine why you got the life insurance in the first place, which is probably to protect them financially. A big loan hanging out there could mean they get way less than you intended, maybe even nothing if the loan grows large enough compared to the death benefit.
And that leads directly to the absolute worst case scenario, the one the source is really warned about, policy lapse. This happens if the total outstanding loan balance, remember, original loan plus all the unpaid compounding interest grows so large that it actually exceeds the policy's cash surrender value.
Right, we mentioned cash value and cash surrender value. They're often close, especially in older policies after surrender charges fade away, but the trigger is specific. Loan balance exceeds cash surrender value. If that happens, the insurance company has the right, written into the contract, to just terminate the policy, cancel it.
Which means, poof, your life insurance coverage is gone. Completely. All those premiums you paid, maybe for decades, gone in terms of providing that future death benefit. It's a really terrible outcome for something meant to last a lifetime.
And just to make things worse, when a policy lapses with a loan still outstanding, it can trigger what some people call a tax bomb, a nasty surprise from the IRS. One source laid this out pretty clearly. When the policy lapses, the IRS might look at the amount of that outstanding loan, the money you already received, and treat it as taxable income to you in that year. Specifically, you could owe income tax on the gain inside the policy. How is the gain figured? It's generally the total value you receive from the policy, which the IRS considers to include the loan amount you took out minus your cost basis. Your cost basis is basically the total net premiums you paid into the policy over its entire life.
So hang on, even if you get zero cash when the policy actually lapses, because the loan ate up all the value, you could still owe taxes on the growth that happened inside the policy over the years.
Potentially, yes. Let's use that example from the source again. Say you paid $40,000 in premiums over the years. That's your basis. Your cash value grew to $55,000. So there's a $15,000 gain, $55K value, $40K basis. Now, imagine you took out a $50,000 policy loan sometime earlier. If that loan plus interest causes the policy to lapse later, the IRS sees the $50,000 loan as value you received. Since your basis was only $40,000, you have a $10,000 taxable gain, $50K loan, $40K basis. You could get a tax bill for that $10,000 gain, even though the policy is now worthless and you didn't get any new cash when it lapsed.
Wow. Okay. That's a really nasty surprise waiting for someone who isn't paying attention.
It's absolutely a critical consequence. It really underscores why you have to manage these loans actively. That flexibility is great, but it demands discipline.
Okay, let's shift gears a bit and compare these policy loans directly to, say, getting a loan from a bank. How do they stack up based on what the sources say?
Well, first, big difference. Getting the money access and qualification. Policy loan. Super easy, super quick usually. No credit check, no income proof needed. The policy itself is the collateral. It's a right you already have. Bank loan. Generally slower. You've got to meet their strict rules, credit score, income, debt ratios. You might need other collateral too. It's a whole process.
And repayment. Night and day difference. Yeah. Policy loans have that incredible flexibility we talked about. No fixed schedule, no mandatory payments, no penalties for being late short term. Bank loans, Rigid, fixed payment schedule, usually monthly. Miss a payment. Late fees hits your credit report. Big consequences.
Cost is another factor. Interest rates. Policy loan rates, they vary, can be fixed or variable. Often they're pretty competitive, maybe lower than an unsecured personal loan, but maybe higher than something like a home equity loan. Bank loan rates, all over the map, depends heavily on your credit, the loan type, the market. Plus, banks might charge fees, origination fees, sometimes prepayment penalties even.
And the impact, right? What does it do to your financial picture? Policy loan, it's private, between you and the insurer. Doesn't show up on your credit report, doesn't affect your credit score. Bank loan. It's reported. It will impact your credit score. Could help it if you pay perfectly. Will definitely hurt it if you miss payments. Less privacy, too. The bank knows why you're borrowing, usually.
So putting it all together, when does a policy loan seem like the smart move, according to the sources? Often it's when you need cash fast for an emergency or maybe a time-sensitive opportunity, or if you maybe can't qualify for a bank loan right now, credit issues, income instability. Also, if you really value that repayment flexibility and privacy. And here's an interesting one. If you want your policy's cash value to keep growing as if the loan wasn't there, because usually the policy's guarantees and potential dividends are still based on the full cash value, even with a loan against it, or maybe just as a temporary bridge loan while you arrange other financing, and of course, using the money for absolutely anything.
Okay, but when might a bank loan, maybe even one secured by the policy's cash value, actually be better?
Well, if you need a really big amount, more than you can borrow from the policy itself. Or, crucially, if you have great credit and can definitely qualify for a significantly lower interest rate elsewhere. If minimizing the interest cost is your absolute top priority, more important than flexibility or privacy, then a bank loan might win out.
You mentioned securing a bank loan with the cash value. How does that work?
Yeah, it's called a collateral assignment. You basically tell the insurance company to assign a certain amount of your cash value over to the bank as security for the bank's loan. This might get you a better rate from the bank than an unsecured loan, but it's still a bank loan. You still have to qualify, go through their process, deal with the fixed payments, credit reporting, all that. And as one expert pointed out, you generally can't double dip. If you've assigned, say, $50K of cash value to a bank, you typically can't also take out a $50K policy loan from the insurer against that same value.
You know, this whole discussion touches on that classic debate. Permanent life insurance versus just buy term and invest the difference. While that's a huge topic for another day, in this specific context of accessing cash, the sources kind of hint at the practical reality. A lot of people who intend to invest the difference, well, they just don't, or not consistently, or maybe not well. But even if you do invest that difference successfully, getting cash out usually means selling investments. Maybe selling low if the market's down. Plus, you might owe capital gains taxes. A policy loan, if the policy is managed right, offers that predictable access, lets the underlying cash value keep growing, mostly shielded from market swings. That's a different kind of benefit in some situations.
Yeah, it really boils down to understanding that these are different tools, different characteristics, different benefits, and definitely different risks depending on your situation and the economy.
And to really see those risks in action, let's dive into that real-world example from Reddit that our listener sent. This is someone really facing the sharp end of mismanaging a policy loan.
Right. So what we have is a 55-year-old guy in the U.S. He's got a whole life policy. Death benefit is pretty decent, over $112,000. But, and this is the problem, his cash surrender value is really low now, only about $8,182. And the kicker, he has an outstanding policy loan balance of over $43,000.
Yeah, he says in the post he foolishly took out a big loan years ago and apparently just didn't manage it, didn't pay the interest, presumably. So now that loan, $43K plus, is way, way bigger than his cash surrender value, $8K or plus. He's gotten a notice from the insurance company saying, basically, warning bells are ringing. Your policy is about to lapse. You need to pay $1,025 immediately just to keep it alive a little longer.
And his big question, because he explicitly says he doesn't have any dependents who need the death benefit, is pretty stark. Does it make any sense to pay this $1,000 plus man, and probably more down the line, to keep this policy going when the loan is huge, the death benefit isn't needed for anyone, and that loan is just chewing up what little value is left?
Let's look at his choices based on everything we've just talked about. Option 1, he pays the $1,025. What does that do? Well, that payment probably covers interest that's overdue, maybe a tiny bit of premium or principal, just enough to get the policy back in good standing temporarily. It buys him some time. It keeps that $112K plus death benefit active for now. But that massive $43,000 loan, it's still there. And it's still racking up interest every single day. That interest gets added to the balance, making the loan grow even bigger, it'll keep eating away at that small $8 cash value and reducing the net death benefit. So the real question for him, since he has no dependents, is what's the point? What's the value in paying $1,000 plus now, facing more costs later just to maintain a death benefit nobody needs while the loan keeps getting worse?
Okay, option 2. He says, forget it, doesn't pay the $1,025 and just lets the policy lapse. Consequences. Well, first, he loses that $112,000 plus death benefit immediately. The protection is gone, kaput. But, like we discussed, there's that potential tax bomb lurking. When it lapses with that $43,000 plus loan outstanding, the IRS could see that loan amount as taxable income to him. He might owe tax on the gain calculated as the value received, the $43K plus loan, plus maybe any tiny bit of remaining CSV, minus his cost basis, total premiums paid.
And we don't know his cost basis from the post, right? That's the missing piece.
Exactly. Let's imagine he paid, say, $35,000 in premiums over the years. That's his basis. The IRS sees the $43K plus loan as value received. The gain is $43K plus minus $35K equals roughly $8,000 plus loan. He could owe income tax on that $8 pay plus loan. Now, if he'd paid way more in premiums, say his basis was $50,000, then the $43K plus loan is less than his basis. In that case, maybe there's no taxable gain from the loan itself when it lapses. The point is, finding out his exact cost basis is absolutely critical for him to figure out the potential tax hit if he lets it lapse.
What about the advice he was getting on Reddit? Anything useful there?
Well, it's forum advice. Take it with a grain of salt. But some common themes came up. People told him to get an in-force illustration. That's standard. It's a projection from the insurer showing how the policy values, the loan, everything is expected to play out over time. It would show him exactly when it's projected to lapse if he does nothing.
Okay, that makes sense. See the train wreck coming.
Yeah. Some mention that old policies can be good, meaning they might have better underlying costs or guarantees than newer ones. True, perhaps, but doesn't solve the loan problem. Others threw out ideas like maybe withdrawing cash value up to his basis that's usually tax-free, maybe use that to pay down the loan a bit. Or more complex stuff like a 1035 exchange, trying to roll the policy and the loan usually into a new policy or maybe an annuity. But like the sources suggest, a 1035 exchange just moves the problem. The loan and the interest still exist in the new product. The debt doesn't just disappear.
Man, that Reddit story really puts a fine point on it, doesn't it? Policy loans seem easy and flexible.
But if you don't manage them, if you let that interest compound without paying it, you can absolutely lose the insurance and get hit with a surprise tax bill. It's a really powerful but potentially dangerous combination. Discipline is key.
Okay, let's try and wrap this up. Let's distill the key takeaways from this deep dive based on our sources. First, permanent life insurance. The kind with cash value. It does offer this potentially really useful way to get cash during your life via policy loans. It's flexible, it's often easy to access without the usual bank hassles, it's private, and it lets the underlying asset keep growing tax deferred.
But that access isn't free. You pay interest to the insurance company. And while you don't have to make payments on a set schedule, ignoring the loan and the interest has serious, potentially devastating results. That unpaid balance chips away at the death benefit your family might be counting on. Reduces it significantly over time.
And the absolute biggest danger, hammered home by that real-world example, if the loan, bloated by compounding interest, gets bigger than the policy's cash surrender value, the insurer can just cancel the policy, lapse it, you lose the coverage entirely, and you could face a significant, totally unexpected tax bill on all the gains that built up inside the policy over the years, even if you see no cash at the end.
So that idea we started with, borrowing your own money, it sounds good, but the reality, as the sources show, is just more complicated than that. It's really about using an asset within a specific insurance contract as leverage. And like any leverage, it has costs and it definitely has risks. You have to understand them. You have to manage them. Policy loans aren't inherently good or bad. They're just a tool. How well they work or how dangerous they are really depends on your understanding, your situation, and critically, your discipline to handle that flexibility responsibly.
So is this tool right for you, the listener? It really comes down to your specific financial picture, why you might need the cash, what your goals are, and maybe most importantly, as one source kind of hinted with that practical reality point about savings habits, what's your financial discipline like? Can you actually manage this kind of loan responsibly given there's no one forcing you to make payments? Or would that flexibility actually be a trap?
Yeah, these are big decisions. Life insurance, loans against it. they have long-term consequences, and all our sources strongly suggest getting professional advice.
Absolutely. Before you jump into taking a policy loan, or if you have one that's maybe getting a bit out of control, talk to a qualified financial advisor. Someone who could actually look at your policy, your numbers, your situation, and help you figure out the best course of action based on your goals and, your financial habits. It's complex stuff. Get personalized advice.
Understanding how it all works, the mechanics and the risks, that's the essential first step. Hopefully, this deep dive gave you a much clearer picture today.
Yeah, I hope so too. It really makes you think, doesn't it? How well does your own self-discipline match up with a financial tool that offers so much freedom, but also demands so much responsibility? Answering that might tell you a lot about the right path for your own financial security.